Now, what type of sectors would I be avoiding? And I have already made several videos on that, and I have showed you which stocks I have sold also. So a sector that is going to perform terribly according to me is going to be commodities. Now, which type of stocks will I be purchasing? So I have recently invested money in something like I had already made a video on that. Hi everyone, welcome to today's video. So here is a very quick commentary by John Williams, who is the president of US Fed, and he says that a recession in the US is not his baseline scenario.
Is recession a base case of yours? Is it a probable case? Where do you put the probability of recession right now?
Well, first of all, the recession is not my base case right now. I think the economy is strong.
So in simple terms, he's saying that, you know what, we are not going to go through a recession. But on the flip side, if you hear the commentary of Michael Burry, so he keeps on saying that, you know what, stock market is going to go bust, it is going to go to absolute zero, etc., etc. If you consume mainstream media, they are again saying that, you know what, recession scenario is very, very high, and by next year, almost all the economists are predicting a recession. In India, something crazy is happening, that people are saying that, you know what, we are going to become like a $5 trillion economy by 2026 for a wide variety of reasons. So since there are so many contradictory viewpoints that are existing, it is confusing people. They are sitting with a lot of cash on the sidelines, hoping that the markets will correct even more, and then we will enter into the stock market. Should you be doing it? Should you not be doing it? We have had a series of conversation around it. But on this video, what I'm going to do is that I'm going to systematically break down this topic of recession for you. What type of sectors you should be investing in, vis-a-vis what type of sectors you should be avoiding, by what time the recovery will start, how will it start. So that's the entire conversation that we will have in simple, easy to understand bullet points. So let us get the conversation started. And also, if you're looking to invest in US stocks, right now the US stocks, especially tech stocks, have corrected quite a lot. So I've created a series of different vests. You can go check it out in case it makes sense. If it aligns with your risk appetite, you could consider investing in those stocks. But before doing it, read the entire pinned comment section and description section. So first and foremost, let us understand the commentary around recession, because some people are saying that, you know what, recession is already there. Some people are saying that recession is not really there. So are people lying? The answer is no. And one of the most sensible commentaries that have been done on this topic is by Bill Ackman. So he's a legendary investor. He runs his own hedge fund, which has performed exceedingly well. So this is what he says, and I will break apart the tweets. So Bill Ackman says that a recession is defined as 2-quarter decline in real as opposed to nominal GDP. So is he right? The answer is yes and no. He's right in his own way, and he's also incorrect because there is no standard definition of recession. Many people define it differently. They do it by nominal GDP. Some do it by real GDP. So what is the difference between these 2 points? Very, very important thing to understand here, because all the data that I've shown you, it has to do with just understanding this singular difference. So nominal growth rate is defined as a combination of real growth rate plus inflation. So think about it this way, that if the growth rate of an economy is 12%, but the inflation in that economy is 9%, then what is the real growth rate of that particular economy? It will be 3%. So if you're defining growth in terms of nominal growth, then of course recession is not there. Why? Because inflation in the economy right now is very, very high. Similarly, if you're defining recession from a real point of view, then yes, we are in a very bad situation that real growth will not happen. Now here, referring to the chief economic advisor's statement, and here is a tweet also that I have done explaining the math behind it. He feels that by 2026, India will become a $5 trillion economy. But what commentary is he giving? He is giving a nominal GDP based commentary. So please remember that, and also view my tweet here. It will give you more clarity. So back to Bill Ackman, and basically what he says is that in order for the world to grow in real terms, any real terms, you need to have a nominal GDP growth of greater than 8.6%, which is absolutely correct, because right now there are very high levels of inflation in the economy. So if we understand his hidden message, what he is simply trying to say is that the real growth in the economy will be very, very low, but the nominal growth in the economy will be very, very high, all thanks to inflation. So the obvious question comes that will this kill our economy, and are we heading towards a perennial form of recession? Because you know what, there is stagflation scenario, there is recession scenario, there is 1930 depression like scenario. So this is what Bill Ackman has to say on that topic. So he says since the nominal spending growth is roughly 8%, this puts us technically in a recession. So yes, technically we are in a recession, no doubt about that. But should you worry? You should only worry if two scenarios are playing out. First and foremost, if the companies are not producing enough. And second key thing is that if the consumers are demanding very less, for example, a lot of goods are being produced in the economy, but no one is buying it, or companies are just struggling to produce because of high debt, because of low availability of credit and bunch of other macroeconomic problems. So is that really happening? So he goes on to say that consumers are spending substantially more this year compared to the last Also, if you take a look at Q2 earnings and revenue projections, they have beaten the estimates of several analysts. So there is no reason to worry per se. So this is the central message that he is saying. I will link the tweet in the description box. You can go check it out, read the entire commentary on it. This brings us to the second point that, okay, fine, Bill Ackman's commentary, but can you show us more macroeconomic data? Yes. So this brings us to point number 2. So there is a very clear relationship between stock market valuation and inflation. And there are 2-3 data points that I will show you here. So first and foremost, whenever you see this line, this is inflation line, and you will see this gray line. This is the stock market valuation line, at what price the stocks are generally trading. So you will see in the past that back in 2001, if you analyze that crash, you will see that inflation here was very, very high and stock market valuations were at the lowest. So whenever inflation starts peaking, the stock market valuation goes to its absolute bottom and then it shoots up. Same has happened here, that stock market valuation bottom shoots up. Same has happened here. Stock market valuations almost bottom. There is a bull run, so to say. And now something similar has happened very, very recently, that the stock market valuation was here very, very low. Inflation was very, very high. Now it has started to come down. So you tell me what is going to happen as per the historic data. That are the stock market valuations going to go up from this point or not? If they are going to go up, then probably this is the best time to invest from that particular perspective. So more to that point, so let us check the inflation all across the world in general and the inflation in India. So let us start with inflation expected data. So expected data means that what is going to happen in the next 5 to 10 years when it comes to inflation projections. So these are projections, they can be off, but several macroeconomists are projecting these data. So I'm presenting you an aggregate picture, but yes, things can be off. These are estimates and estimates can go wrong. So let us look at the India inflation expectation in the next few years. So right now we are here and the expectation is that the inflation is going to come down. So inflation has already peaked here. Now, as per the previous graph, we have categorically seen that whenever inflation peaks, during that time, the stock market valuation is at its lowest. And whenever that peak inflation starts to come down, the stock market valuations or stock prices actually start generating positive returns. So inflation expectation, even in a country like India, it is falling. That inflation is going to get tamed. So what happens at a world level? So let us take a look at the US data here. So again, these are growth projections that inflation has gone up. It has peaked and now it has started to come down on a sustainable basis. So this is the US data. So both India and US data are categorically pointing out to the fact that the inflation is coming down. So this brings us to the fourth point and a more rational and fundamental analysis of the entire situation, that if you think about it, that why the inflation went so high. So it happened very high because of high money printing. And second was that there were commodity crises. So things like agricultural produce, things like oil, they became really expensive. Now the excess money in the economy is getting sucked out of the economy because Feds have already increased the interest rate. Even in India, the RBI has already increased the interest rate. So that excess money has gotten out a lot. So this is part 1. Part 2, what about commodity prices? So here is the expectation of Citibank about the most important commodity these days, which is oil. And they expect oil prices to fall to $45 a barrel by 2023. So inflation again, as per the fundamental data, also looks like that it is going to fall. Now this is the production and consumption data of fuels, and you can again see that there was a shock to the economy roughly in 2020, first half of 2021 period. There was low consumption, low production during this phase. Now it is getting back to these previous levels. So from that particular perspective, even the commodity shock looks like it has been absorbed to a very large extent. Now you would say that, okay, fine, this is just oil. What about like other core sectors in the economy? And what about production of FMCG, consumer durables, autos, etc.? So now I can't show you the data for every sector out there. So please do your own homework, but I will show you one very important piece of data which has to do with automobile manufacturing in the world. So you will clearly see that the forecast suggests that the auto production is going up even compared to baseline years of 2018-2019. These were the total production volumes. They are secularly going up. So this is a positive sign in the economy because automobile production data indicates that people are ready to consume more stuff or more luxurious stuff in the economy, which is a healthy sign for any economy. So this brings us to the final 2 points of the video, that okay, by how much the Nifty is going to go up or the markets are going to go up, when, which sectors should I be investing in, which sectors I should not be investing in. So let me give you a very quick commentary. Again, these are predictions. Predictions can be off. So please do your own due diligence. So here is the Nifty view that from its top, it has roughly fallen by 12-13% as of now, which is a fairly big fall. Now, if the markets go up, then what is the baseline that has already been set? So there is a likely scenario of immediate growth of 14.5%. Now, there can be a situation where the market falls further because so much of negative commentary has already been given on recession, and this news can be blown up in order to further discount the stocks. So till what point the stock markets can fall? So this is the first support level and this is the second support level for the Nifty. So first one comes out at roughly 15,100 and the second comes out at roughly 14,400. I'm investing as per this logic. I do not see markets crashing below 14,400 due to recessionary concerns. Also, please mark the word because people listen only half the video, understand half the logic and start investing money. Please understand, I will say these words again. It will not be due to recessionary concerns that the markets are going to fall below 14,400. So this is my outlook. If some new stuff happens in the economy because of which the markets fall, of course I can't promise you that it will not fall below that. But right now both these support levels look very, very strong, especially the 14,400 support level. That is very, very strong. My assessment would be that everyone is predicting an elongated crisis by 2023. So in 2023 is when the market should start giving massive up moves. And the market should trade roughly 14,400 levels to 19,000 levels in this particular year and first half of next year. So these are my approximation and my bet on the stock market. Now, what type of sectors would I be avoiding? And I have already made several videos on that and I have showed you which stocks I have sold also. So a sector that is going to perform terribly according to me is going to be commodities. Why is that? Because the commodity prices, as I talked about on one of my earlier points on this video, the commodity prices are coming down. Oil is coming down as a result. Majority of the oil stocks and oil companies are going to suffer from this point because commodity cycles are fairly long. So this is the first key sector that I would avoid. Second key thing that I am not going to invest heavily in FMCG or defensive sectors from this point heavily. So please note the word heavily. That does not mean that I have lost faith on Hindustan Unilever, Nestle, this, that. No, nothing like that. In general, I am telling you that defensive stocks do not do fairly well in a low inflation average growth environment. So I am going to avoid it. Now, which type of stocks will I be purchasing? So I have recently invested money in something like TCS. I had already made a video on that. You can go check it. I am buying US tech companies quite aggressively now. They are heavily discounted. So I'm buying them. You have to do it? No, absolutely not. Please do your own due diligence. Another sector that I'm very, very bullish about from this point is banking because banks have terribly underperformed. Here is the chart for last 5-year performance of HDFC Bank and you will see that the performance has been horrible. Literally horrible for a bank like HDFC Bank, which has done so well in terms of generating customer outreach, in terms of the financials. So I personally feel that tech, banking, finance stocks are undervalued at this juncture. I am buying it heavily and consistently. Can I be wrong? Of course I can be wrong. You need to do your own due diligence and take positions accordingly. I hope you enjoyed the video. Please press the like button and I will see you soon.